Hello, YouTube. We see greed re-entering the market and the S&P put in a triple top on the daily chart or having a really hard time at this 429.6 area. Why does that matter? Well, because that's our math number. Our 61% Fibonacci retracement is at 429.61. Our highs this week were 429.62, 429.62, and 429.6, which means, in my opinion, now we are really going sideways. Today was nearly a bullish engulfing candle. And when we look here to SPX, as we did yesterday, the highs, 99.28, 99.19, and then 98.01. Three lower highs, marginal lower highs. We look here to the E-mini futures. We got 05.75, 04.75, 02.5, which means lower lows all three times. So it's a time to sell the extreme greed because, as we know, we buy fear, sell greed, and right now it is getting extreme. So as we've been looking at for the last couple of days, we're mostly focused on the charts because until we're given a reason to sell, we want to be receptive that, yes, we could go sideways to up. Sideways just means that we don't have a clear pattern or clear trend in terms of up or down. But the really important thing is that the market generally takes the staircase up and then the elevator down. So if you're not prepared for that elevator down, that's how our seasonality chart could get formed, where we have a nice big sell, we dead cat bounce, and then go lower, and then ultimately resume up. What's really important about tomorrow's action as well is that we have ES rollover, which means that we're rolling the June contract into September. Not going to go beyond that because it confuses a lot of people. What I will focus on here is the fear and greed, where we've noted that in the title, we're seeing greed or extreme greed we have not seen in 6+ months. That's right. Since early February, late January, we've not been able to get above a 75. So what this tells me is that if we're going to form a higher low and it is above the previous high at about 69, which means if we're able to hold on to 70 for the fear and greed, I think we can go higher. So it's not a guarantee, but as of right now, we're into 76. Yesterday, we were at 74. A week ago, we were at 61. So we can push even higher. And that comes down to the market can remain irrational longer than you can remain solvent. I'm going to ask you for a huge favor, please, and thank you. If you could consider smashing that thumbs up and subscribing to the channel, I would greatly appreciate that. And as we look forward here to our heat map, if you want to join us and get more information beyond YouTube, you can join us for a 14-day free trial to trade with me, Justin from the Algo, where people have asked a couple of questions in the comments. There's a lot of things you get. I encourage you to go to the website if you want to learn more, because it's a 14-day free trial, which means you literally have nothing to lose and everything to gain. Anyways, yesterday we were looking at I forgot to show this, so I posted it on Slack after, but for today, it's very similar to yesterday, where we see green in the morning, and then when we go to a 4-hour chart, it's completely gray, which means we did nothing into the afternoon. So on a 4-hour chart, we would notice this. Why does this matter? Well, because yesterday we saw the big sells in Google, Amazon, Apple, Nvidia. All those came in the morning, and then the afternoon looked just like this. So I'm noticing rotation. So what I think is really important here is that we got a negative print, meaning jobless prints actually going higher. Market went up, which means bad data is good. There's a conflicting data point today as well, which is going to be the GDP now. And this tells us what we are expecting for GDP growth going into this next year. And it got revised from 1.9 up here to about 2.19. So as I look forward here to another indicator, which we looked at yesterday, this is now at 72.5, which means the market is pricing in a 72% chance we're going to be pausing and a 27% chance we're going to see a hike. So if the market is a future discount mechanism, is it already priced in? Well, Pat from our group here, Pat S., big shout out to you. VIX is at 13.64. Not sure what that means. Well, there's a definition here from Investopedia. VIX below 20 means that the market is stable, stress-free period. I call that calm, cool, collected, expecting zero volatility. So where are we on the VIX? We're at 13.66. That chart cannot catch a bid. It cannot rally, and it is fading. It is even lower than 2021. This is the lowest level we've seen it since the big C, which came in when? In February, when we were at 13.38, and our low is at 14.2. Oh my goodness. We are back to, everything looks like it's back to normal. In the teens, 13 is the lowest teen. So from 13 to 19, that signifies that The VIX is calm, cool, collected. Over 20, it means we're seeing volatility. And over 30, volatility is elevated. Right now, the market appears priced for perfection. And according to a closing basis on the S&P as well, we're technically 20% off the closing low as of today's close, officially bull market territory. So Justin, I'm confused because you told me that we should be looking to sell, but you're telling me some reasons why I should be bullish. Yes, what I'm trying to do is to plant the seed right now, as we have over the last little bit, that at some point we will go lower. We have to go sideways before we go lower. And today we got a fail breakdown. So on the monthly chart, we're looking at a fail breakout. Well, here we have a failed breakdown, and I provided exact notes on how to trade this today. So we opened up, pushed down, come up, and then we actually digested all these moves. I was looking for a move potentially to about 428 in these real bodies. We managed to reclaim that and actually push even higher. Looking at QQQ, what's notable here is that we've been talking about QQQ leading, and honestly, this is a lot more than I was expecting to see happen today. What we noticed was that at the open, we pushed up to about 350. We backed off. We rallied up, gathered more steam, and made it all the way up to our Tuesday low, which ended up being that bearish engulfing area. The bulls defended the higher low. They rallied us up, and it doesn't look all that bad. What's missing? Volume. So it looks like the bulls are trying to chew time off the clock until we get the Powell. And when I look here, if we can clear the 353.93 on the daily chart, that would start to invalidate a head and shoulders. And additionally, that is where we have our monthly breakout end over the previous monthly high. It's only about $1 off. So if we close a weekly chart below that, I will be paying particular attention to it. 353.93 is the number. And we're going to be around tomorrow for the stream. I'll be there with Mason. So tune in if you want to see everything that we are looking for. So what I'm really trying to do here, if it's not clear yet, is I'm trying to give you a warning that at some point, I believe at some point, in the next 3 to 6 months, this is a monthly log scale chart for the SPY or the S&P 500, which means in a couple more lines or a couple more candles, we're due for a move like this. The VIX at 13, for me, literally tells us that it is a stable, stress-free period, calm, cool, collected, nothing can be wrong. And when I read the definition of complacency here, we just have to cool off before the next big rally. Even Stanley Druckenmiller was talking about it yesterday, how he wants to hold on to AI for the next 2 to 3 years. Well, if we get a warning like this, I don't think we ignore it. Let us make that higher high, 432. And then we can start to look at if it's going to self-fulfill. Until then, it's been a beautiful run up until here. And when we hit resistance, what do? Well, we take profit. So it's not a guarantee yet. The battle the S&P is having for right now is for the 61% retracement, which the NASDAQ already got over. So we note that it got over it. It backtested it once, it backtested it twice, and it bounced. So depending on what time frame you're looking at, daily, weekly, monthly, might get a different story. Higher high, higher low. That's a failed breakout. But depending on how you like to slice the data, this is also just a bullish pattern. It's now looking like a doji, and we have these lower tails, which mean dip buying coming in. We filled our daily gap. Looks fine. So we can go higher. And I think that some relief in other sectors is what's going to really drive this up. So if on a trailing 7-day, it is bright green for almost every sector other than Google, Microsoft slightly red, NVIDIA only up a little bit, Apple up 1.6. This just appears like a pop in a flag where we're digesting what we already got. Pop, flag. Are we going to pop and flag again? Or are we going to pop and sag where now we come back down for a retracement somewhere? Or are we just going to go sideways? Please make sure to drop me a comment and tell me what you think. All right, tying it all together, going into a weekly close. Right now, we have Microsoft, Apple, and QQQ in the monthly fail breakout territory, but SPY is not, which means technically with the weekly setup, this is the pattern I was looking for today that I shared to our group if you're curious. So here it was. It was the 352.9 low from Tuesday. Once that got recaptured, our in-a-day target got revised higher, a tool that we have in our group, and that led to the market going up, up, up all day. So let's look at a couple more quick charts here because I think it's also important to note what is actually happening with the dollar. The dollar tanked, so lower high, lower low, and if we look here to our one-day chart, I believe this is the one I'm looking for. It's stuck between the 50 and 200 MAs. It's looking like a cup and handle, to be honest. So we got a cup, we got a handle, we got a bounce. I'm not sure which way it's going to go, but this is going to really give us clues in terms of where the S&P goes. And we note all these upper tails here. So it looks like after the Bank of Canada raised rates yesterday, we got that tail. Now they're like, okay, go back and sell it. Why? Because the Fed is going to pause. There's a 3 in 4 chance they're going to do that as of right now. And then if we look here at something like, there's 2 more quick charts I want to look at here. First one's going to be S5FI. What is that? It's stocks above their 50-day moving average in the S&P 500. And that is currently at 56.77, which means 1 in 2 stocks in the S&P 500 is above its short-term price. We're also set up for a golden cross here, which means lagging momentum is going to start crossing over. Look at this chart here, S5TH, and this is S&P 500 stocks above their 200 DMA. And it's roughly at 1 and 2. So what roughly 1 and 2 stocks is now starting to trend higher. We never got that death cross, which means we're actually still in a golden cross from December. It looks like momentum is starting to build up. And if you want to watch more, I encourage you to watch our weekend deep dive now queued up here on the left-hand side. I thank you so much for watching, and I look forward to seeing you tomorrow. Thank you.